Welcome everybody to the Real Dealz podcast, one of the top-ranked real estate investing podcasts for the last 7 years. This is the place to be for investing strategies you can actually use, expert interviews, and of course, some good old-fashioned entertainment. Now, here's your host for the show, Elliot, the REI guy, Smith.
What's going on, Real Dealz podcast listeners? I am at you here with show 378. This week, I had an investor call. I do monthly investor calls. I just started it last month. But I have a lot of people that are looking to place capital. And so I started doing a monthly investor call to talk about the deals we have in our pipeline, to bring on other syndicators, people that are raising capital, such as like Brandon Turner, our buddy Artem Templer, and some other guys around the country that I know. And so what I'm going for is twofold. I am going for one, I am talking more about deals to people that are trying to invest. So I want to always be a couple steps ahead of them so I know how to answer their questions. But then we also go over deals that other people might have and things like that. So we broke down this week a deal from Brandon Turner that they put out. They funded it in 6 days. It was a 530 unit in Houston, Texas. Looked like a really good deal. I know some of the general partners were also putting money into this deal. Funded in 6 days. I think they raised something like $20-some million. So good for them. But we kind of broke it down, went through what my thoughts were on it. And then after that, we answered some Q&A from questions that had been sent from the last meeting and kind of went over those things. And I think there's some really good nuggets in here. So I recorded it and I'm putting it out the second half where they were doing more of the Q&A, because it's kind of hard to see because I'm going over a PDF web form. So it's kind of hard to see on a podcast. So I sent out the second half. I will upload the first half and the whole thing onto my YouTube channel. It's just Elliot Smith REI. I am putting some of the stuff out there as well. So I think it's really good information. It's especially if you're raising capital, you're talking to private investors, you're trying to fund your deals, really having this conversation is something that you need to learn how to have it. I see a lot of people out there that are paying investors 10, 12, 14% plus points, and you really don't need to in this environment. Money needs a home, and money will go for a lesser yield. So we generally get 6 to 8%. I will pay 9% sometimes as well, depending on whose money it is. But I have people that I can make one phone call and say, hey, I need to fund this deal. It costs X. I want X. I can fund the rehab, or can you fund the rehab? And they'll say, sure, where do I wire the money to? So you have to build rapport with your investors. And it's a relationship, and you have to look after their money like you would your mother's money or your father's money or your sister's money. And so we talk a lot about in there of why I'm not pressing on deals, why we're not forcing deals, what kind of deals we're going after, what kind of deals are important to us, my thought processes on owning a lot of rentals versus, a handful of rentals that are paid for. So really, I think this is a lot of good information that you can use in your daily day-to-day business. So pretty excited about that show for you guys to hear it. What's going on with us this week? Short week with the holiday. We kind of got backed up a little bit, just normal business stuff, trying to get caught up. And then we are turning around really quick. I did work Monday, but it was kind of an off day because most people weren't working today. And then we're going again back up to Coeur d'Alene today to hang out with some friends for the weekend. Should be really, really enjoyable. Some of the guys that I met when I was in New York a couple weeks ago. And so, but Monty's going, Chris is going, the families are going. So it should be a really enjoyable time. Other than that, not much new here, other than we have a lot of maybes in our development pipeline. And so we're kind of drawing the marketing back just a touch because we got a lot of really good leads in there. And now it's time to kind of start working those leads and making sure that we can get the ones that are maybe, or some of the ones that we have under contract, to a stage where they can be maybe deals to then they can be to make money deals. So I talk about that in the show today, some of the stuff we have going on. Also, we are ramping up the marketing. We are basically finished building our lists for our multifamily. That's a process in itself because multifamily is sometimes harder to get a lot of the information when you're going on the bigger stuff. So we have a CoStar. We've gotten CoStar, so we got a lot of good information from there. And then I have my team going through, I broke it down to about 4,000 units, or not units, but properties. And now I have my team going through and filling out all the missing information, making sure we have the correct people to mail to, making sure we're building a file basically for each seller and each property so we can have a good understanding. Then what we'll do is we'll break it down into categories. So we're going from $2 to $12 million purchase price. And we are then breaking it down into 4 different categories. So we'll go premium, next level, premium, next level, and next level. So each level will get different types of marketing, and the premium side, the top 10% will get more money spent on it on marketing than maybe the bottom half will, but they're all going to get, good amount of money spent per lead on there. So really, I think we're going to do really well with that, especially in Washington State with a lot of the stuff they're putting out. They've changed a lot of the rules. They're trying to get rid of any kind of evictions basically. And so that's been another thing that we've been working on this week as well, is trying to figure out where we're going to. They did lift the rent increase moratorium. So we did send out some rent increases this week. Didn't send it out to everybody because we don't want a ton of people moving out all at once. We wouldn't be able to handle the turnovers. So we're segmenting it, every month we're sending out rent increases. So then we're not just slammed with turnovers if that's what people want to do, because our rents are way, way below market value. So anyway, other than that, like I said, the second half of this will be, the first half actually will be on YouTube. That's something that you probably need to see visually. The second half is something really good to listen to. That will also be on YouTube, and you can see that visually as well. But that YouTube channel is Elliott Smith REI. It's the same as my Instagram account. And so hopefully you guys find value in this. This is something that will help you very, very much in your investing career and raising money from from private capital people. So you have to learn how to talk their language. A couple of things. They're scared. They don't want to lose their money. That's the first thing, is you need to tell them how they're not going to lose their money. And then how are you going to protect their money? And then what kind of return are they going to get? Most return is not always the most important thing. They just want some return, and they don't want you to lose their money. So protect their money at all costs. So a lot of these people are just making high incomes, or they have money sitting on the sidelines. They just need to do something with it. So a lot of times if you do a higher return, people equate higher 10, 12, 14% returns with risk. So the lower the return, they think it's less risky. And plus there's so much money out there, you don't need to pay that much interest right now. I think you guys are really going to like the show today. So really quick, we're going to listen to our sponsor, and then we're going to get into it. Stick around.
All right, Real Dealz podcast listeners, I want to talk quickly about our show's sponsor, Iron Bridge Lending. If you guys have not reached out to Iron Bridge already to talk to them about funding some of your upcoming flip projects, I highly encourage you to do so. I've known the owner of Iron Bridge for a very long time. I personally borrowed millions of dollars from them over the years to do a number of different projects, and I can say without a doubt, they are the best hard money lending company I have ever come across, and that is the reason why they are the sole sponsor of this show. I've had a lot of other companies reach out to me and want to sponsor this show, but I just won't do it. I feel like I need to be genuine in who we have sponsoring the show, and it needs to be somebody that I've personally done a ton of business with. So I personally vouch for their ability to be the best, hands down, in the world of hard money lending. You won't find better programs, you won't find better terms, and they're lending or will be lending in over 20 states. So chances are, if you're hearing this in whatever state you're in, it's definitely worth it to check out their website, reach out to them, see if they're lending in your state, and if they are, I would absolutely encourage you to do business with them. Another very cool thing to note is that they have a program for most rehabs where you can actually borrow up to 90% of the purchase price. Now, this is given the fact that you are actually buying a deal, which if you're listening to the show, that means you probably are. But if you have an actual deal on the table, they'll fund up to 90% of your purchase price, and they'll even give you rehab funds on top of that, which means that it only takes 10% down to get into a project, which is unbelievable in the hard money world. So do yourself a favor, reach out to Iron Bridge Lending, have a conversation with them, see if they're a good fit for you and for your next project. I can guarantee you that you'll be happy that you did.
These deals do fund really quickly, though. This 6 days to raise the $20 million for this deal. So there's a lot of dry powder, people looking for cash, put cash somewhere.
I have a question to ask you. So from their perspective, why do so many syndications want to sell out 5-10 years, like that time frame?
It's just where they're annualized. That's where it just seems to work. That's just where their returns, like they start getting stagnant, I think, if they hold them for quite a bit longer.
I think if you run the IRR analysis on these apartments, they kind of start the rate of return, internal rate of return just starts plateauing around somewhere between year 5 and year 10. And then these guys have to kind of justify their fees. So they just keep finding different deals, right?
Yeah.
So they make more for themselves by acquiring the deals, not holding them.
Yeah.
Syndicators make money. They're just moving money. They're just trying to move money in assets, right? And they're trying to run those assets. Now you can make a ton of money in these deals, but that's why they're willing to give up such a big piece of the pie, because they're just trying to place capital. They're going to take their 2% acquisition fee. They're going to take their asset management fee. They're going to take their capital placement fee. This deal only has 5 or 6 guys in the deal, 4 or 5 guys in the general partnership side. You start adding those fees up. It's a lot of money. And so then they need to move capital as quickly as possible, because that is how they generate more, more money. So we have a little bit same thought process on our deals. I want to be I want to be out of Washington in the next 5 to 7 years if things continue to go the way they're going with, just the policies that are in place. Really, the idea that we have in my mind is, how do I get enough assets in multifamily, is something that we're really good at, and take those and then 1031 them, if it's still there, into something that's like a triple net commercial, something commercial that's more insulated, like, a long-term lease on an Amazon, fulfillment factory, a FedEx factory, shipping center, where they're doing like the last mile delivery, things like that, things that are going to be a lot more insulated, in a probably less liberal state. So, really, I just want to I want to grow my capital as much as I can right now, take $5, $10, $15 million, leverage that into something else that's worth $20, $30, $40 million. It just spits cash to a certain extent, or place it in a lot of different things that, that are triple net, that are more set it and forget it. It's kind of the thought process, but that's where we're at. So, all right, that is that one. I'm going to go back to the next thing. So our current pipeline, Rudd sent me a text about where we're at in Benton City. We are, by the way, our prices look good for Richard for our 13 unit. It's starting to come down.
That's good.
So just got our topo maps today for that development for all those lots. Now we're going for a zoning change and an updated plat map. And so we're doing well. We came to an agreement with the other property owner to double the development out there in Benton City. That's the 60 lot subdivision. So we went from like 24 lots to go to 60. We're going to try to get a zone change to get the density a little bit better. So we're working on that one. We also are talking with the cities in Benton City for the apartment complex that we have the 3 plots tied up that we're going to build. I think we can build an 18 unit possibly, but for sure like a 14 unit. So we're looking at that, and we're going to go for the 18 unit because we can go high. The property sits kind of on a little slope, but we can build off the back. We can kind of build like daylight basement kind of deal where people come around and back park. We think we can go 4 stories high on that. And so that could be good. The issues that we're running into, and I know this is where people get frustrated because they want to put capital in and it's just kind of, takes the fire out of it. The cities are backed up extremely so far. Before COVID, in Kennewick, the city of Kennewick, it would take 3 to 5 months to go from deal to pre-approved to moving dirt. They're now at 14 to 18 months. And that's in Kennewick. So we're fighting this on all fronts. We have another deal in Pasco that we're working on that came from our marketing. That's 10 acres that we're looking. It's in West Pasco, and we're just getting pushback after pushback, and it's a very slow process. So it just is very, very slow. And it's hard for somebody like my personality who comes from the flipping world, that's instant gratification, that wants to move deals and put money in place. And I feel the pressure, but it just is a patient waiting game. That's why if you need to place capital, I'm going to show you deals every month or operators that if you need to place capital today, go place it with them. So I don't, in the meantime, but just know you lock your money away with those guys when you do that. But most of you guys are continuing to make more money, so it's okay. The idea that we have, I'm going to jump one down. So talk about being patient with your capital is important. This is not the time to rush capital placement. This is a time to be very patient and wait. Yes, you might be losing money to inflation. Yes, you could be getting a return. But if you get into a bad deal right now, you're going to lose a lot more stress, sleep, and capital than if you were just patient. If you set your money in a simple IRA fund, a mutual fund or something, and let it sit there while you're waiting, that maybe hopefully keeps up with the rate of inflation, that's an option. We do have some lots that we're going to be building. Red's going to be building stuff out. We can get your capital in play and things like that when we start building. It's going to be more of a one-off deal. We also have a full marketing campaign going for all apartments from 2 to 12 million in the state of Washington. We should be launching that marketing campaign next week with very, very high quality mailers. We are very good at that. So we should have more of those deals. Those are existing deals, apartments that we're going to be looking at buying and placing capital in those deals. And we will be raising money for those. So be patient. I don't feel pressure. I don't want to feel pressure to place your capital, because if I do that, mistakes happen. So we'll just keep going and money will always be there. And we'll just keep doing these every month for you guys to watch them. But it is important to be patient right now. So Richard had a few questions from the last one. Details of deal structuring and financing. How does it change with the equity amount? So, and will we present an investment opportunity? Yeah, we'll present an investment opportunity. And I'll kind of go over a thought process when we go over and dive into our deal that we bought last month. And if we were to raise capital for that, how we would have looked at it. But it's going to be different on deal to deal basis. Obvious, we want everybody to win. So, depending on where we're buying the property, we might give more to the LPs. If I think I'm getting a smoking deal, then I might come down closer to 50-50, where everybody's still really winning. But really, we want to make sure that we're taking care of all the limited partners and try to be very consistent on your returns and go from there. So things will change from deal to deal. Also, buy and hold will be different. From development will be different to buy and build and hold will be different, and trying to find the most advantageous tax strategies to keep capital and not pay as much taxes on those things. Details of the loan terms, duration, financing costs. So I can talk about the loan terms for like when we would pull properties out, but loan terms for if you're just making a straight loan, we will on like a build and things, we will give you a full build out of draw time. The idea is you don't want to give us too much money, but you want to give us too little money, because we want to keep as much money at working as possible, paying you interest at that point. But we will have timeframes in there. Just know there is supply chain issues, so timeframes could vary greatly. So we will, whenever we underwrite a deal, we will pencil in extra timeframes to make sure that we're penciling that in and the project still works with interest being paid. If you are lending on, like say you're buying a lot for us or something like that, and we have to go get bank financing to build something, you will at that point have to subordinate to the bank. We will at certain levels personally guarantee. I'll probably personally guarantee a lot of the money on those deals. I can't speak for Rudd's buildings houses he's building, but a lot of the stuff that I'm involved in, I will personally guarantee the money that I borrow. If I have to sell everything off and pay everybody back, I will sell everything off. So I want to protect your capital. That is number one. So we would send that out. If you don't fully fund the project, how do we become subordinate? You basically just subordinate to the projects, the bank money that we get, or somebody that has to be in first position. So you just subordinate, you'd be second, and we go from there.
In terms of that question, I think the person was saying hypothetically, if you're looking at like investors like us, right? Like just random people, what if we came up with 80% of the money, or like let's say like we came up with 40% of, say you needed $1 million and we only came up with 250. the other 750 comes in from other investors, right? Would they be?
That was the next question. That's on the next question.
Okay.
Yeah. So that one's a little bit different. So there's two different ways on that. If let's take the first one would be like, we're doing a build, like you're going to loan me money and I need to go to a bank to get the rest of the money. You would automatically subordinate. So there is different levels of where the debt comes in and who gets paid back first. Banks are going to always be in first position. Then you guys would be, if we had to bring some other person there, and then limited partners would be there. And then general partners would be the next one up. So it goes bank debt, first position, mezzanine debt. This is for like raising for syndication. Mezzanine debt would be like seconds, seller carryback seconds, things like that. Then limited partners, and then Elliott, the general partnership team. Now, if you guys fund 30%, we find another 70%. And who are you treated the same as the other 70% of the investors? So the other limited partners, you are treated exactly the same. How in my mind this works is, say we received $1 million and I borrowed $2 million from limited partners. So that I got $1 million back in the deal. That $1 million, and I have 10 investors. All 10 investors would get $100,000. Everybody would be equal at that point. It's not going to be first money in, first money out. It would be equal to everybody because we want everybody to raise together. So nobody in the limited partnership would be treated any differently than the other people. Make sense?
Mm-hmm.
So IRR, cash flow, cash on cash return projections for investors, and project level. Can you give a rough idea? Different category investment. I will send out a chart on this, but basically if you lend money on a simple interest loan, it's 8%. That's annualized year over year. We want to keep it working all through the year. If you only give me money for 6 months and it's 8%, you're really only getting 4% on that money if it's not working. So we want to make sure we don't want to pay too much because I'm going to go to cheaper debt. So we want to be right in line with everybody else. We can get debt from anywhere from 6 to 10%, is really what it can be. So 8% is right in the middle there. And I want to make sure I'm keeping the money working. If we were doing a development deal, that's going to be a deal by deal basis. That's going to be a lot higher returns because there's more risk to that. So those returns, I would have to project those out on the deal itself. If you're coming in as a partnership, as like a syndication partnership. On the apartments, if say we go buy an apartment, the idea I would have on those would be a 50-50 limited partner to a general partnership. You guys would probably the investors would probably bring majority of the cash in for the down payment. We would help fund reserves and things like that. We would, depending on the deal and how much equity you're gaining on the deal, is how much money we would want to put in the deal ourselves. So then only thing we would take would be an acquisitions fee. And it would probably be something very reasonable just to cover our overhead and cover our marketing costs for getting those deals to continue getting that. And then we would just charge back costs on the property. So any management fees, maintenance, repairs, things like that, we would just charge those back at cost. We don't need to make money on those things. We don't need to make money on management or anything like that. And that would be very transparent. We would probably be at a 6% preferred return is probably where we would shoot at for a cash on cash preferred return, but our annualized will be a lot higher. Now we will probably say it's going to be in the 15 to 18% return range, but I will be shooting for quite a bit higher, and I will dive in and show you where that works in the deal when we go over that next deal. So waterfall, how's waterfall change percentage of equity and performance of an investment? That's going to be a deal by deal basis. So, and waterfalls, I'm not as fully read up on how the waterfall clauses change things, but that would be a deal by deal basis that we would write into the contract. Buy and hold or sale holding period. Some of us want to buy and hold instead of on investments for long haul. I do too. Honestly, if we could have 100 or 200 units fully paid off, we're sitting pretty good at the end of the day. So I don't need to be like those guys that have 3,000 plus doors. I don't need to have that much. I don't need to be that leveraged. The idea would be if we can get a group of people that really want to just buy a bunch of properties, pay them down, maybe we keep them leveraged at 50% LTV. We can move that cash into other deals. Great. Or if we want to have properties that are paid off, that sounds great too. I mean, really, I can live really well off 40 paid units, paid off houses. I could probably live a pretty good lifestyle. And so for right now, we still have properties that my wife bought when she was 20 that we haven't sold. Now our return on equity is lower, but we're about to pay it off, and then I can tap that equity if I need to, but I don't need to at this point. So we don't need to sell it because it still cash flows really well. Why sell things when we already have assets that are performing? Would you agree with that, Richard?
Yeah, that's always like my frustration when I like listen to Bigger Pockets, right? Like people are like, oh, you have a paid off property that's like terrible. And I'm like, well, there's no risk and I can always leverage it.
You can always leverage it.
I can always leverage it and then like change my like return. Like it's not that big of a deal.
Well, the idea is the American way is more, bigger, better, faster, stronger, right? That is the American way. So they want to own 10,000 units or 100,000 units, these syndications, when they really only own 2% or 5% of these, you know, they don't own that much of these buildings, but they can say they own 10,000 units, right? It's a feather in their cap, right? That's an ego thing. Really, again, if we have 10 of us and we have 200 units that are all paid off, we're all doing pretty freaking well at the end of the day, right? That's the idea. And if we want to recapitalize, we can sell off our underperforming assets that might be in a fringe C area and go put it into more of an A, B area. Take that. So then we take a property. The idea would be, say we have a property that's paid off. Take that and we have a ton of equity. Go put that in a A-class apartment complex and put 50% down. Roll it all into the property. And then we have an A-class property that takes, you know, a lot better care of. It's a lot less maintenance overhead and pain in the ass. That's
what I've always thought. But like, yeah, that's why like I'm always surprised that these syndication people just, I mean, I understand that they need to make money on all their, like, they're just moving money to make money, right?
Correct.
But like, I've always thought like it would just be great to like build like a 200 unit complex in Bellevue where you're charging like, you know,
if you build a 200 unit complex in Bellevue, you're in the $1 billion range, half $1 billion range of buildings. So,
you know, okay, maybe Bellevue's not like,
we need a few more doctors.
Yeah. A-class property and then just like sitting on the like cash flow from there.
Correct. Now there is something to be said of opportunity cost for money though. So if we tie up our money and we run out of money to have opportunity, we always want to make sure we have powder dry and opportunity when things come across. That's why I go back to, I don't press, because if I put money in a bad deal, I lose opportunity cost. And that's the idea. Randy's invested with me for what, 3 years now, Randy?
Are we more?
4 years. And I never press deals. We never push, right? But the deals we do, they're good, really good deals.
Yeah.
So that's kind of thought there. Exit strategy, that's going to be based on what the group collectively decides, I think, to a certain point, and what we just talked about. Percentage of sponsor equity, how much are you putting into each deal? Or on the flip side, what is your take percentage of the profit? It's going to go deal by deal. I kind of talked over that a little bit, but we'll probably look at a 50-50 on most existing building buy and holds, things like that. That's what we'll probably look at, 50-50 LP, GP. You guys will probably fund most of the down payment. Getting into the property, we'll run the management. We find the deal, we run the management, you guys bring the money. Each deal needs 3 parts: money, operators, and the deal. If we'll bring 2 out of the 3 parts, and you guys bring the other third, and we'll split it 50-50. So you guys are getting good upside. Impact of inflation. So we invest now or wait. Construction costs looks to be coming down. So I think I just watched a video today about pending home sales are declining sharper and sooner than they have in 19 and 18 and historically. So I think this is a very unsure time. A lot of the jobs being added are entry-level service sector jobs coming back, not a ton of money. The opportunity right now is in affordable housing. That's why we're so bullish on Benton City. I'm so bullish on apartments, building apartments here locally in Tri-Cities. Affordable housing is important. I don't want to be, I don't want to be stuck doing a 60 lot subdivision with $700,000 houses right now. That's not where I want to be. Now, one-offs that Rudd has, from here and there, or 5 or 10. Okay. I think you can cover those pretty well. You can insulate yourself pretty well there, but I think being patient right now is probably the best thing you can do with your money. That's what we're doing with our money.
Sorry. I think the question also had to relate to like interest rates. You said like, like if interest rates go up like a percentage point or 2 percentage points over the next 2 to 5 years. And if we had bought something and then, we're going to refinance, like we have to potentially refinance, or there's an arm or something like that. Or if we wait 3 years, if the interest rates go up, like say 5%, I mean, like it's something crazy, right? Would there be a significant drop in the price at that point in time? 5 years. I mean, granted, you would have had to sit on cash for 5 years.
There will be a drop in price, but it's going to balance each other out with your cap rate will balance it out with what you're paying in a mortgage rate. The idea right now is we want to lock in long-term debt now, and we want to lock in as long as we can. So Randy and I did a deal, the 8-unit, it was under $1 million loan. So we had to go with a credit union. It's a 5-year term and 5-year resets. Now it's a 30-year amortization loan, but we have to reset every 5 years. So we need to really pay attention to that. The deals, the reason we're going after deals that are $2 million to $2 to $12 million is we can do a Freddie Mac product can be a 10-year term, 2-year interest only, 3-year interest only in prime markets, sometimes up to 10 years interest only. So your cash flow is really, really good, but we wouldn't want to do it too long because we want some debt pay down. But the idea is we want to push that can down as far as we can. The other thing with Freddie Mac product is that the loans are assumable. So you have an asset right there in that property. So say interest rates go to 6%, right? And we have a 3.95% mortgage first position that is assumable. That is a valuable asset right there, because then we can sell that note and we can do a seller carryback second or whatever. We can get money for the second or whatever it is. So if there's 5 years left on the term, they're going to buy that note. They want to be in that position because interest rates are so much lower on that. So really, does that make sense, Richard?
So if you got a 4% interest rate now, 2 years from now, 2 years later, it goes up to 6%. Interest rates go up to 6%. Who's buying the 4% note?
So say somebody want to sell the building. Say we want to sell the building. We need to sell it for whatever reason, right? Yeah. That mortgage is assumable.
Oh, so you can sell it to somebody and say, hey, part of the deal is
you just take over my 4% mortgage, right? So so that loan's assumable for a 1% fee. So that's why we're searching in that area. Worst case scenario, explain what the worst case scenarios are for different projects, or are they all the same in syndication as it pertains to an investor? Worst case is we lose all our money. I don't think that happens, but the worst case is you are investing. Now, the idea that you're going to lose all your money is very slim to none. We're buying assets. We're buying things that have intrinsic value. You can't go rebuild them for X amount of costs. Now, say we have another COVID thing and it wipes out half the population. Well, those assets are going to be worth a lot less. That looks very slim of happening. But the riskier deals will be the development deals. Those are the ones that are riskier, because you're buying dirt that has some value, but it has more value if we put streets, pipes, and houses on it. But in order to get it to be that more valuable spot, we have to spend a bunch of money to put streets, pipes, and houses on it. So things happen in that timeline because it's such a long time frame. That's why I'd be more cautious on higher priced, subdivisions as I would be on entry level subdivisions. Worst case, if say we get stuck with a subdivision, then we do a 60-unit entry level housing subdivision, which this actually could be best case because I actually want to keep a lot of these houses personally. But worst case is that we plan to sell them. Well, and we can't sell them, but there's still people that need to live. So we rent them out, and we build in enough buffer with our pricing that we still have a lot of room to still get loans at 80%, 75% LTV, where we can still get loans where we still get majority, if not all of our cash back out at that point. That would be the idea. So why invest with me? You guys are looking at platforms like, there are syndicators that we talked about today, or looking at people like CrowdStreet and things like that. So the difference between somebody like me and a CrowdStreet or a syndicator is, we kind of talked a little bit about it, is they're taking a ton of fees. They're taking a lot of fees in the deal. they're having to place capital. They need to go place capital. They are going to get usually lower returns than what I would project that we get. They're up here, and we're the kids that are biting at their heels trying to grow up to a certain level. So we need capital too. But we're going to have to give a little bit more of our deals away because we don't have as big of a track record as them. The CrowdStreet platforms, those are fine in a way that, yeah, you should get a decent return, but there's also a lot of people in that deal that have to make money. CrowdStreet, the operators, the guys that are, all these different people have to make money. We're cutting that out. And so that money is going back to the collective. Also, the question I have on CrowdStreet, if the deal is so good, why are you having to go to a platform like CrowdStreet to raise capital? You're just checking the easy button at some point, but why don't you? I've had investors growing up since we've started in this business the entire time, and I've grown more and more investors as I've gone, and I've never lost an investor. So why don't people that are putting together 530 unit deals, why don't they have an investor pipeline like that? Why are they having to go to CrowdStreet? Why are these guys that are doing the 530 unit in Houston having to go to a Brandon Turner to go raise capital? Those are questions that I would ask for that. Lastly, we're here. We want to have fun. We want to build a community of people like we talked about earlier. If we just own 200 doors free and clear, that's really cool. For example, 2 weeks, about a month ago, we had a tenant die in our property. He was dead in there for a couple of days. There was a hoarder. It was a hoarder. It was really gross. We want to send that out to you guys and say, so you're going to talk about it to your buddies, and you can see it. It's in Washington. Hopefully the deals are mainly all in Washington. They're in Tri-Cities. You can see them, you can touch them, you can feel them, you can drive to them within 3 hours. You can talk about them to the deals with your buddies. We'll update you on fun things that are going on and keep you involved in the sense where you feel like you're connected to this deal. And it's different than just putting money into a deal and saying, okay, I'll see a quarterly, sheet every month, every quarter. We want to let you experience this because it's fun. Real estate investing is fun. And I know when I worked a job at Franz, all I could think about is doing fun stuff because Franz was monotonous and wasn't that fun. And so doing real estate is fun. It's exciting. It gets you out of your comfort zone a little bit. And it's the same reason I invest in stocks. I don't do it to make money. I just do it because it's fun. And I want to have conversational pieces with other people when I can talk about those things. So that would be why I would say investing with us is some good points. But again, I'm going to give you operators from all over the country and give you opportunities to invest your money with other people because really I want to do what's best for you guys. I never have a fear of being able to raise money for deals. I know I can raise money if the deal's right in a minute. And so we just want to give you guys as much opportunity as possible because building wealth in real estate is probably one of the greatest tools you can have. I think it's going to outperform so many other assets unless you're really aggressive in your stocks. And I think it's something that you can actually touch and feel. Real estate dropped quite a bit in 2008, but apartments didn't drop that much in value, but stocks and bonds and retirements sure dropped a lot. And even if they drop 50% in value, because for whatever reason, if we still have tenants in there, we're still getting monthly cash flow. It's like a dividend paying stock. And it doesn't turn off unless somehow we lose 50% of our tenants. And if we're in good areas and entry level price points, I find that highly unlikely that we would do that. That would happen. So that's that. Cool. Do you guys want to run through the other deal really quick, or you want to call it at that? The one that we already bought and kind of just give you an idea, or do you want me to do a separate video and I can send that out later?
I think you can send that out later.
Yeah.
Okay. Pretty standard stuff, right?
Yeah, it's pretty standard.
Yeah.
So anyway, I will be working on doing a video. If I can get him on live in the evening, I will send out an invite to people if they want to join with Brandon and I so they can hop on and listen. But I will be sending the video out of that. We should hopefully be hopping on here in the next couple of weeks. I'm hanging out this week with Ken McElroy. I might try to talk him into doing a video with me as well. And then also next month, I will have a different operator on, hopefully Ken or somebody like that we can dive into the deals that they're doing and opportunities they may have coming up in the future. And then hopefully we'll have more traction and stuff going on our stuff here locally.
I mean, I feel like those big syndications, they're just all over the place. I get pitched them all those kind of stuff all the time, but I just feel like when it's all said and done, your returns are so low. I don't really.
Yeah. So the idea that I have, Randy, and we can go a different direction, that's fine. The idea I have is I want people to look at different asset classes and start to be able to understand different asset classes and different investment opportunities. Right. And really, because I want people to make confident decisions when they invest with me. And so I want them, if they can get a little bit more knowledge, they can make more confident decisions on deals that when we present deals and going forward.
Right. Okay.
That would be my thought process. And I'm fine to change it and make these.
No, I think that makes sense. I think I don't want to speak for Richard, but the reason Richard and I are here is because we're willing to spend a little bit more time, but we want something better than we're looking for things that's just better than the mass syndication deals, right?
I agree. I don't want to pitch syndication deals either. That's not my idea. My idea is that we have deals in the pipeline to put money in. But if I don't have any deals, I want to give everybody options too. If they have money burning a hole in their pocket.
Right. Okay.
So I just want to,
we're all sitting on more cash than we like, but like you said, patience is key in today's environment, right?
Yeah. I mean, just with 5 guys that I can name off the top of my head right now, a couple of them sitting here, I mean, we can go do some damage. I mean, we can go do some damage. We can go get a pretty good deal. And my team is actively, we have hired an executive assistant. We have hired, I have a full-time sales manager. I have an assistant for my sales manager. I partner with Greg Lynch on the West Side as well for finding deals. They have a full sales team on it. We are actively looking for buy and hold real estate. And then we're also here in the Tri-Cities looking for development deals and build and hold. So, but it just takes a while for me to build this machine up because I'm also working that call center as well. So, but my time is getting pushed back more towards this. And so I expect these things to come, but again, I won't press. I won't push deals.
Cool.
Yeah, I think it's just like kind of like a waiting thing. Like, cause I don't like, cause like the backstory, Randy, is like Elliot came to me with like this deal and I was like, I don't have that much money, but I can ask some people and see if they're interested. And then long story short, it didn't come through, but people are like, hey, are we going to do something? Yes or no? We kind of set up an LLC. And I was like, well, if we want to put some money in play, I can ask Elliot for some other ideas if you really want to put some money into the market. But I'm kind of like you, I don't want to really invest in a syndication unless I have to. Like, I kind of want to control the real estate, if that makes sense. And I don't have to control it, right? It could be through Elliot, or it could be like, it could be through a partnership. But I just feel like I'm like another step removed from the syndication, if that makes sense.
You're 50 steps. You're so many steps. You're not calling Brandon Turner. Yeah, you're not calling Brandon Turner and being like, hey, what's going on with this syndication? Or Brian Murray or the guys running it. You know what I mean? You get what you get from them, whenever they want to
have it. Like, I could sit down and talk to you at like in 3 years and we're like, okay, like this is what we're thinking. And I was like, okay, well, what if I want to keep it or something? Like, let's try.
Exactly. Yeah. So say I want to sell out in 3 years and you're like, your group says, hey, we want to keep it. Okay. How do we structure that?
Right.
How do we do that? We had a commercial building that we own in downtown Pasco. My buddy brought us the deal that we're building a 13 unit on. And he was a third owner in that with us as well. We wanted to get out of the commercial building. We had 60,000 of our own cash. We funded the cash part of it when we bought it 2 years ago. He's like, how about we just give you your 60 grand back and swap equity in deals and call it a good day? Absolutely. I want to get out of this deal. You don't want to do this one because you don't want to be spread too thin. Give me my money back. Let's swap equity. Easy day. Everybody's happy. So that happens when you do these, work with guys like us that you're one phone call away.